A company said no to $24 billion. Not a lowball, not a scam. A serious all-stock offer from the single largest warehouse owner on the planet, rejected the same day it landed, on a building portfolio that wasn't struggling, wasn't in trouble, wasn't going anywhere. A month later, the buyer came back. Same buildings, same tenants, same square footage, $2 billion more. Why would anyone pay $2 billion extra for exactly what they'd already offered to buy? The answer sits inside a fact almost nobody buying warehouses actually understands. The building was never the asset. In 2022, Prologis, the largest owner of industrial warehouse space on Earth, tried to buy a rival, Duke Realty, for close to $24 billion. Duke's board turned it down, calling the offer insufficient. A month later, Prologis returned with $26 billion, and this time Duke said yes. The buildings hadn't changed in 30 days. What Prologis was actually paying more for, by its own CEO's account, was Duke's footprint in a handful of specific geographies it expected to keep winning for years. Southern California, New Jersey, South Florida, Chicago, Dallas, Atlanta. Not concrete, not steel. Zip codes. That $2 billion gap is the whole thesis of this video. Here's the fantasy everyone starts with. You buy an empty box. No customers to charm, no product to design, no marketing to run. A company rents the box, fills it with their own inventory, and pays you every month to do almost nothing. It's the closest thing real estate offers to being a landlord for people who don't even show up. Passive, boring, safe. Prologis, the largest owner of industrial warehouse space on Earth, runs a portfolio worth more than $100 billion on exactly this premise. And yet the company spends less energy collecting rent than it spends on a single obsessive question, out of an entire country, which few miles of land will actually matter 5 years from now. Because a warehouse in the wrong spot isn't a slow, steady asset quietly making money in the background. It's a liability that ages badly in public. Empty aisles, carrying cost with no tenant, a building too far from where people actually live to be worth filling. So why does a few miles of location matter more than almost anything else in real estate? Why did Amazon once pay over $750 million for a robotics company almost nobody had heard of? And why, years after everyone assumed e-commerce made warehouses the safest bet in the economy, is space sitting empty across the country right now? By the end of this, you'll understand what people inside industrial real estate understand and almost no one else does. A warehouse was never a building. It's a bet on how fast the world expects its stuff to show up. And that bet comes with an expiration date nobody prints on the deed. Start with the part people get wrong first. Buying a warehouse feels like buying steel and concrete. It isn't. You're buying proximity to highways, to ports, to the exact population clusters where a company's customers live. Two identical buildings, same size, same materials, can be worth wildly different amounts depending on how many miles they sit from a highway interchange. The building is almost worthless without the location stapled to it. That's why the industry doesn't really sort warehouses by square footage anymore. It sorts them by proximity tier. Bulk distribution centers sit far from cities, often over 1 million square feet, holding inventory that later ships out in bulk to smaller hubs. Last-mile facilities sit as close to dense population centers as zoning will allow. Smaller, more expensive per square foot. Built for one job, shrinking the final delivery distance down to minutes instead of hours. Look at Southern California's Inland Empire, one of the largest concentrations of warehouse space on the planet. Built almost entirely because it sits within a short drive of the ports of Los Angeles and Long Beach and the sprawling population of the entire region. 2 buildings there, same size, same age, one 3 miles from the freeway. 115 can lease for genuinely different money. Same box, different bet. So what happens when the whole country starts expecting its packages the next day? As 2-day shipping became the baseline and same-day crept into major markets, last-mile space didn't just get pricier. In some cases, it started commanding several times the rent of a bulk facility a few miles further out. The building didn't change. The distance between that building and someone's front door did. Now the stakes escalate, because this same obsession with speed explains one of the strangest-looking acquisitions in modern logistics history. In 2012, Amazon bought Kiva Systems, a company that built small orange robots capable of lifting an entire shelving unit and carrying it to a human, instead of making that human walk the length of a warehouse to fetch one item. Price tag, roughly $775 million for what looked from the outside like a niche robotics startup. Here's why that number wasn't crazy. Inside most fulfillment operations, labor, not rent, is usually the single biggest recurring cost. A system that lets one worker pick and pack noticeably more items per hour doesn't just tidy up efficiency. It goes straight for the largest line item on the balance sheet, and it handed Amazon a multi-year head start over every competitor, still making people walk miles of concrete every shift. The warehouse business isn't really about the warehouse. Some of its most valuable innovations have almost nothing to do with the building, and everything to do with what happens to labor cost inside it. Then came the overcorrection nobody saw coming until it already happened. During the early 2020s, as online shopping surged, developers raced to build industrial space almost simultaneously, all betting that pandemic-era growth would simply keep climbing. It didn't. As restrictions eased, shoppers drifted back toward physical stores, and e-commerce growth cooled back toward its old, unremarkable trend line. The new supply kept arriving anyway. Vacancy rates in several major industrial markets climbed noticeably off their historic lows. In some regions, brand new state-of-the-art facilities sat empty for months, waiting on tenants who weren't materializing at the pace anyone had projected. That's the trap sitting quietly under this entire industry. A warehouse takes years to plan, permit, and pour. Consumer demand can flip direction in a fraction of that time, which means developers are always betting years into the future, using a picture of demand that can look completely different by the time the concrete finishes. Curing. Compare that to what kept Prologis standing through multiple cycles. Not chasing whatever demand spike was loudest that year, concentrating instead on what the industry calls infill locations. Land already boxed in by dense development, with no room left nearby for a competitor to build something newer or cheaper next door. A warehouse on open land can always be outcompeted by whoever builds next. A warehouse with no next door left to build on can't be. But even the best located warehouse carries a risk most investors underweight until a downturn actually lands on their desk. Warehouse leases run long, 5, 10, sometimes 15 years, which sounds like stability. It is, right up until the tenant stops being able to pay. A warehouse's income is only as solid as the company that signed the lease. Picture a national retail chain, the kind that once leased millions of square feet across dozens of distribution centers, filing for bankruptcy and shutting its stores almost overnight. Every one of those warehouses is still standing, still specialized, still built for one company's exact operation. But the lease behind it is now just paper, and the landlord is holding a highly customized building with no one left to fill it. So picture two versions of the same bet. In the first, a developer chases the hottest trend at the exact moment everyone else is chasing it, builds bulk space on open land with nothing stopping a competitor from building next door, signs tenants mid-boom without asking whether their business survives a slowdown. Growth cools, new supply from copycat developers keeps landing, rents stall, vacancy climbs, and the building just sits there, still costing money every month. In the second, the owner picks scarce infill land where competing supply is structurally capped, spreads tenants across industries so one bankruptcy can't gut the portfolio, and treats every long lease as a bet on that tenant's staying power, not a guaranteed decade of income. When the market cools, this warehouse doesn't just survive. It often gets more valuable, because the same scarcity that made it expensive to build is exactly what stops anyone from flooding the area with cheaper space. Which brings us back to that $26 billion number. Prologis wasn't paying more for Duke Realty's concrete or steel. Those hadn't changed in a month. It was paying for the geographies Duke had spent a decade quietly assembling, land nobody else could easily replicate. Duke's board understood the same thing the day they rejected $24 billion. The building was never the asset. The location and how defensible it was the actual business the whole time. So go back to the fantasy we opened with. The simplest business imaginable, an empty box someone else pays you to fill. That dream isn't wrong. It's just missing a warning label. You don't own a passive building. You own a geographic bet on human behavior, priced in real time by everyone who wants to buy what you're sitting on. Sometimes the smartest number in the deal isn't what the building is worth today. It's what it's worth the day nobody wants your zip code anymore. And $2 billion paid for the right zip codes is a lot cheaper than finding that out late.